Capitaland Ascendas REIT FY 2024 financial results dated 6 February 2025. Okay, we'll quickly look at the key highlights. Right, distributable income is up 2.2% year on year. Distribution per unit is up 0.3% year on year. Right, this is although it's a flattish performance, right, it's quite decent considering most other REITs actually dropped their DPU this financial year. Right, investment properties looks like it's revalued downwards by 1% versus last year's result, 31st December 2023. Right, portfolio occupancy is lower at 92.8% versus end of last year, which is 94.2%. Right, but positive rental revisions at 11.6% is relatively impressive considering that at mid-year, which is the first half guidance, right, they actually projected FY 2024 to have rental revisions of overall high single digit, right? So the fact that they managed to hit double digit, although it's a low double digit, is a decent performance, right? Healthy aggregate leverage of 37.7%, even though they have perpetual securities. We'll talk about this more later, right? This is slightly lower than before. Right, cost of debt may have peaked. Alright, we'll see that one of the good things is that I think their financial costs have dropped, right, as we'll see in more details later. Right, the whole FY 2024 versus 2023, we'll see that revenue is up 2.9%, right, NPI is up 2.6%, available amount for distribution is up 2.2%, generally positive things, right, DPU is up 0.3%. Right, part of the reason why it doesn't match up with the 2.2% increase in amount distributed is because of the higher number of units, right? So the number of units has gone up, available units, that means the number of shares has gone up, right, by 1.9%, right, mainly due to issuance of units for partial payment of base management fees in June 2024 and December 2024, right? I'm not sure whether this number is correct or not. It's like up by 1.9%, which looks like quite high, right? Later I'll show you a number that looks different from this, right? 1.9% for management fees, and this is not the full fees, right? This is actually 20% of the fees, right? So 1.9% of your whole base to pay the management for 20% of the fees is quite high. That means your full fee is 10% of the total number of units, which I think is highly improbable, right? So we'll try and look at this a little bit more detail later, right? So anyway, first half 2024 versus second half 2024 versus first half 2024, right? Gross revenue is down 2.2%, all right, mainly due to some divestments, all right. NPI is down 1.3%. Right, we like that they are lowering operating expenses. You can see this drop is smaller than the previous one. Right, DPU amount available for distribution is actually up. Right, again, this is mainly due to lower interest expense. Right, so that's why I'm a bit hopeful that interest costs have peaked. Right, DPU is up 2.1%. Right, so it's actually a decent performance versus first half. Right, despite the fact first half has better revenue. Right, second half actually has better DPU. All right. Yeah, the amount of units going up, not by much, right? This is due to management fees, right? Versus second half 2024 versus second half 2023, you can see again revenue is down 1.1%, NPI is up 1.4%, again controlling of operating expenses, right? So management is doing something right? Amount available for distribution is up 3.4%, right? Lower interest expense again coming up. Right, DPU up 3.2%, right? So it's a lot better than last year's second half, right? So you can see that's why in the previous presentation on this REIT, I did say that I think it's on the verge of a turnaround based on the chart I look at from Retirement's blog, right? So you can see second half is better than first half by 2.1% in terms of DPU, and better than last year by 3.2%, right? So hopefully this trend carries on. Right, distribution is 7.68%, right? 7.68 cents. Sorry, this for the latest half, right? And this translates to about 6% yield based on today's price, roughly lah, plus minus a bit 6%. Normally, Ascendas trades below 6% yield. That means to say that currently the price is relatively cheap lah. Okay, relatively cheap. I would say it's very cheap, right? It's hardly very cheap, right? I won't discuss all the properties, right? Because I don't think that is that important. We've been keeping track, right? So they divested 4 properties the whole year, which is 38% to premium to their market valuation, right? So later on I'll try to do a valuation for Ascendas based off their divestments, right? We look at balance sheet, right? Healthy at 37.7%. In fact, it's lower than last year, right? Or last 2 results even, right? That's because their total debt has dropped, right? We are happy to see that, right? So you can see that, yeah, if you look at as of 31st December 2023 to 31st December 2024, this is where the slight difference come about, right? So you see the number of units actually only 0.13% dilution, right? This as opposed to in front, where they say 1.9% of dilution, right? So I think this is the correct number, okay, in terms of units being issued, right? So the number of units issued is 6 million, right, which is 0.13% of the total number of units for management fee, right? That sounds more likely, right, to me. Anyway, here's a slight rough valuation, right? I look at the adjusted NAV per unit, which is $2.20, right? If I look at their sales, right, they sell at 38% above valuation. Ascendas as a whole, if everything can sell at 38% above valuation, it will be $3.03, which I think is not that prudent to value it like that. So I will just give it the 38% a haircut to 20%, right? I assume that everything is roughly 20% below 20% above book value, right? So our value Ascendas at $2.64, right? And this maybe is the fair value of Ascendas REIT, right? Possibly. And if I knock another 5% off, is around $2.51, right? And this price recently we've been seeing, right? So I would think that if you value Ascendas at 1.2% book, 5% off, you get $2.51. I think it's a possible reasonable price to consider adding to Ascendas, right? None of this is financial advice, just my personal thinking, okay? Also based on the fact that the DPU is looking like it's resuming an uptrend, right? So again, not financial advice, right? Interest coverage ratio is actually down slightly from last 31st December 2023, right? 3.7 times to 3.6 times, but it's better than in June, right? So, but I think as long as it's above 3, I think it's decently good, In fact, this is even higher than CICT, right? I think CICT is lower than 3.6, right? So they are generally very high fixed borrowing rates, right? So there's not much room for improvement in cost of debt because most of it is already fixed up, right? Revaluation wise, yeah, it looks like this is the current valuation, right, as opposed to the last year. Okay, for Singapore, it looks like revalue up, alright, and US is down, Australia is down. They didn't talk about UK, which I assume is flat, right? Generally, they are mainly in Singapore, about 66% in Singapore. Australia, US, and UK is all around 10 to 13%, right? So it's about 10, roughly. Then this one is majority Singapore, right? So actually, I prefer their Singapore space, right? You can see that occupancy wise, we do have some concerns across the board. Even Singapore is less than 95%, so not very good occupancy, although there's general marginal improvements over mid-year, right? You can see it's all better than September 24, okay, but mostly lower than December 23, right? So Singapore, as if you look at my last video, I actually look at the breakdown of all the occupancies, right? Changi City is doing very badly, right? So if you look at the last video, you know that, right? But looks like some improvement there, right? And some improvement in logistics property here and business space, right? Occupancy improved to still less than 90%, so US is still a concern, although they are filling up these two logistics properties, right? Australia also improvement, 92.5%, right, due to this improvement in the property, right? UK is always high occupancy, not too much of a concern there. You can see that generally fourth quarter, which is the latest quarter being reported, engineering and IT and data centers are the main demand drivers, right? This is true for the whole FY 2024, right? Rental revisions for Singapore, we just look at the fourth quarter because this is the latest quarter we did not have information on so far, right? 7.2%, right? Mostly the improvement come from logistics side, 17.8%, right? But you can see this is slowing down from the general FY 2024 lah, which is 31.4%, right? So the improvements in fourth quarter is moderating as opposed to the whole year, but this was expected, right? And if you compare to third quarter, it's also the same idea lah, right? You can see third quarter is better than fourth quarter, right? For logistics, right? Business park a bit better than third quarter, right? Industrial and data centers flattish, right? US not so good, right? So it's dropped down from 22.9 to 11.6. Australia down also to 9.6%, right? UK is around 10.9%, but they didn't have information on third quarter. This one I won't worry about it. 17% is due for renewal in FY 2025, right? Generally 20% of the Singapore's rental income is due for renewal. This one is a bit more hopeful that we'll get positive rental renewals, right? US is around 10%, Australia 22.7%. This one I'm not so hopeful. I'm not so optimistic about Australia's economy, right? UK very small, don't have to worry too much, right? So that's roughly the results of Ascendas for FY 2024. If you look at DPU wise, it definitely looks good, alright. It looks like there's a slight discount baked in, alright. But again, none of this is financial advice, right? Just my personal thoughts, right? With that, I thank you for listening.